Okay, folks, we are live. Welcome to Sunday Night Futures Live. This is where we review the opening price action of the major averages. We're going to talk about our short-term and long-term view on the markets, including gold and silver. And we're going to talk about some of the headlines that came out over the weekend that are pretty interesting and what we suspected, but now have been validated. So it's more of the weekly criminality report coming out of Washington, D.C. that I never see a shortage of. So let's begin with saying hello to people. And before I begin, I want to check the comments to see how my audio is. Sean, welcome. Mike, welcome. Franklin, my main caballero, welcome. How's the audio, guys? Everything's good? I've been scalping the video call options. We'll continue to go up on earnings. Okay, congrats on that. Reminder to all, no Christmas trees until after Thanksgiving. No Christmas music until after December the 10th. Thank you. Okay. Well, thanks, Mike. Thank you, Franklin. Appreciate it. Trader Isaac, I got your chart. I'm gonna post it later on. It's going to be a part of. Thank you, Sean. It's going to be a part of our charts we're going to be going over in a little while here. So let's get to it. Let's talk about the opening futures action. We're looking at the ES minis. This is the S&P 500 5-minute chart, and we're flat. There's not much happening here at all. What we are seeing here is a consolidation, a very, very tight consolidation. So I'm not expecting all too much to happen overnight. It may not. Let's take a look at the NQ. That is the NASDAQ 100, by far the leadership group. Actually, I need to rephrase that. It's not the leadership group right now. NQ down fractionally. They opened them higher, but reversed. Let's just throw up an alert here. Our next support level, I want to see if we test it, and if we test it, does it hold? Well, they're selling them now. They have some buying interest. They're taking up some of that selling pressure. So let's move on. Let's take a look at we did the NQ. The Russell 2000. Russell 2000 up. And this is what I was mentioning earlier, that the NQ, the NASDAQ 100 right now is not really the leadership group that it was. It's more the Russell names, the mid-cap names. They're beginning to play catch-up. They're beginning to, because they were in big downtrends. Now you're getting short covering rallies and whatnot. So the NQ is down, whereas the Russell 2000 is up. Let's check in with the Dow Jones. A big outside reversal bar here. A lot of bears just got trapped in the short. So they got short on a break, and then the buyers just came in and bid it up. Bullish engulfing bar, one of my top 5 favorite candlestick patterns. Link below, 5-part video tutorial, free. We are down slightly on the Dow. Well, flat. Not much happening here. But I think the real interesting action is going on in the rut. They're going to take this positive. Let's set up an alert here. Yeah, there they go. All right. So now moving on into the currency arena, looking at the US dollar, which had a terrible week last week. It drifted lower after hours. We're coming off the lows of that after hours trading, but the dollar very, very weak. Whereas, well, as a matter of fact, let's show you the weekly chart of the dollar, and you can see that this is just horrific price action. I mean, multiple support levels taken out, uh, moving averages taken out. You have your moving averages, your shorter duration moving averages now declining, crossing down below one another. This is a technical breakdown on the US dollar, not to be ignored for those that are bullish on the dollar and positioned as such. If you're short of gold mining stocks, commodities, you may not want to be short of those names right now. Now, with the dollar going down. Now, let's check in with the euro. The euro inversely had a very good week last week, as did the yen, but to a greater extent, the euro. And the euro at current is up fractionally. It's down versus the close on Friday, but it's up off of its lows of the session. That's why it's showing green at current. Let's check in with the yen. And the yen uh, is down fractionally. Not much going on here. I don't expect much out of the yen. The one to watch is the euro. That's the largest component of the Dixie basket, which the dollar trades inversely of. Generally, as goes the euro, inversely goes the US dollar. It helps when the yen complements the euro, and that really drives the dollar in the opposite direction of those two currencies. And that's exactly what you saw last week. So now that we have a feel for what's going on in the Forex markets, now we want to set our sights on commodities. And the first one we're going to take a look at is light sweet crude. Now, they opened this down. Sorry about that. That's one of my alerts going off. They opened this down, and this is a good comeback here. This is a head fake breakdown, and they just spiked it back up. Very, very bullish price action on a very short-term chart on light sweet crude. Now, on a weekly time frame, it's not looking so great. It's in a downtrend. It's under a lot of pressure. So I don't think any rally right now is going to last more than a few days, and I think we're going to roll right back over again because the weekly downtrend is firm and it is established now. What I suspect might happen here is a rally up and into this moving average in white, which is roughly the 5-period, 8-period moving average, and that's around $7 to $8.60 the barrel. So a couple of dollars worth of upside potential here for the euro, for oil before it hits stiff resistance. Now, getting back to our 5-minute chart, I got to take that off. Oh, which one is it? Here we go. Sound. Where's the sound? Oh, no. Okay. Apply. Good to go. No more noise. Okay. So light sweet crude early on in the week looking good. Probably going to have some more upside here, but resistance is above. Now, taking a look at Nat Gas, which frankly had a horrific week last week, and I have a position in this. I was hoping for a spike up, but no, they have dropped it under the percentage point. So no. Let's set up an alert here. This could be a head fake. We're seeing a lot of them tonight. NQ just broke to new lower lows versus Friday's. A support level on Friday. Did not take out Friday's lows. There's one support level identified as being the next support level for NQ. We'll go back. We'll take a look at it, see how the price action is. Let me just finish this alert because I'm getting the vibe here that Nat Gas may be doing a head fake breakdown here. Okay. Let's go back to the NQ 5-minute chart. We are now down spot 17%. This is the support level that fired off. Let's see whether or not they fake out bears here. Okay. And let's set up an alert down at the next support level. We'll get notified if, in fact, we do break down below another support level. Then that would spell trouble for the morning. We're nowhere near being concerned about the morning with this price action right now. So NQ lower low. And there we go. We're good to go. All right. Back to the commodities complex. We did not gas. Let's check in with precious metals. Gold being the first off. Gold is down slightly. And last week was the first week, well, not according to Thinkorswim, but you see right now where on this volatility squeeze that we are lighting up bright blue. Once these dots turn red, that means that we are firing off very, very bullish and we're going up a lot higher. So I'm going to go over to you in a little while what our game plan is going to be for the new trading week. So more to come about gold and what I think is going to happen here, what we'll be looking for to validate or invalidate our thesis on gold. So stick around. Let's check in with silver. Silver, very, very tight weekly consolidation here. We are down just shy of a half percentage point. Let's clean this all up. Let's get rid of this. Okay. So what we're looking for on silver is a breakout above 24.61 the ounce on silver. And I think that's going to happen fairly soon. I think that we're going to get a breakout in gold beforehand, but then silver is going to soon to follow, probably in tandem. So I'm liking this setup on silver. In fact, we were buying silver last week for the first time in over a year. Now, looking at ag, No, I want to stay. I want to go to. I want to go to copper first because I was doing a lot of research before the show, and I was scanning for ETFs, and then one of the ETFs that popped up as being in a potential volatility squeeze was copper. And I was kind of taken aback by that. And so here we are. You could see that over the past several weeks, copper is just consolidating really, really tight. And this is going to break out in one direction or the other. It looks as though it's probably going to break out to the upside. You never know until it happens. But in all probability, this gets resolved to the upside. So there's meaning behind this. They call Dr. Copper for a reason. And we'll talk about the whys behind any breakout in copper in a little while. It's on our agenda. Taking a look at, let's go to agriculture. Corn futures still under pressure. They were up last week, but still under pressure. Soybeans, bearish key reversal week. This is not this week. This is last week. Not good, but holding support, holding an uptrend, but under pressure, possibly just a retest of these rising moving averages. This could be a buy. You're going to probably see buyers come in here trying to bid up soybeans. The question is, are there enough buyers to overwhelm sellers? Well, that will let the market figure that one out. I'm not a trader of soybeans. Wheat broke support last week. You can see how this 21 period EMA in orange is acting as really tough resistance for wheat. So the path of least resistance for wheat traders right now is clearly to the short side. Now, it's not a week. It's not a Sunday night if we don't take a look at how our cattle futures are doing, because this impacts my New York strip, which I value very, very much, but it's very expensive. I'd like to see the price come down. And after 2 weeks ago, we had a breakdown last week, no continuation breakdown, very heart-wrenching. But we did find resistance at now the declining 20-period moving average. We haven't traded down below the 20-period EMA on cattle in a long, long time. Since here, last May the 30th to be specific. So what a run. What else do we need to go over? Am I forgetting anything? Let's just check back in with nat gas really quick. I got to make a decision here this week. They are rallying it back. All right, let's see if we can make it through these moving averages. If nat gas gets above $2.98, then it becomes interesting. But till then, I would avoid it. I wanted to go over Bitcoin. Thank you, TF Hatter. Let's check in with Bitcoin. Bitcoin is on our agenda. Excuse me, my agenda as well. Wow. Nice move. Up over 2.75%. Wow. Beautiful. Beautiful. Very nice. Very nice. I dollar cost average in tomorrow. Every Monday, we dollar cost average in Bitcoin. Let's check out and see if we have any sympathy going on here with gold. No. They're not very correlated. Okay. Who else is here? I've seen Mariah Carey's sighting already. Okay. Jody, welcome. Seymour, welcome. Danny, welcome. Okay, let's get to it. So let's talk about the week that's to be. And the U.S. leading economic indicators comes out tomorrow. Nothing big unless they're really, really strong. If they're strong, that means problems for the equity markets. If they're weak, that means good things for the equity markets. Bad news is good news for the equity markets. And as sick as perverse as it is, that's the way it is. Tuesday, existing home sales. We also get minutes. I thought minutes came out last week. I guess not. Minutes come out this week. Wednesday, they're going to do initial jobless claims on Wednesday this week. It usually comes out on Thursday because Thursday is Thanksgiving. Happy Thanksgiving to everyone, in case I forget. Durable goods on Wednesday. Big, big number, that durable goods. And, of course, consumer sentiment, very important. Back on Friday, services PMI, that's just barely holding on to expansion. And we also get manufacturing, which is just barely below expansion. It's still in a contractionary phase. And I didn't pull up earnings for this week, but I could see that NVIDIA reports this coming week. NVIDIA, Zoom. So this is going to be a big, big week for earnings. Just one company alone, NVIDIA. So let's get to the value of the market. We are back above a 30 handle. We were here on Thursday night above a 30 handle. We closed out the week above a 30 handle on the Schiller PE ratio. Quite expensive. Now, this came out. Mike Johnson, the new speaker, released the J6 footage. And there's a lot of it. Thousands and thousands of hours. And what you're seeing here is pretty much what these tapes reveal. I mean, really not much of insurrection. So clearly, this was a contrived event by the thugs, and I'm Democratic thugs, Republican thugs. They're all colluding on this to make sure that Donald Trump or another Donald Trump never happens again. He's not a part of the club. He's never supposed to be there. He was not indoctrinated into their regime, and this was to block him from ever seeking office again. It didn't work. So Mike Johnson, to his credit, this is what Kevin McCarthy was supposed to have done immediately after taking the speakership role back in January. Never did. Why? It's because he's part of the Uniparty. And you could say that the Democrats are corrupt, and they are corrupt. A lot of them, most of them. But so are most of the Republicans. So a pox in both their houses. Now, here's this guy, a Fed. Here's his badge. He was embedded along with a bunch of other Feds, as we already knew. They're calling them Fedsurrectionists. And they were stirring up problems in the crowd. And, this is just part of the J6 footage that's coming out. And the narrative in D.C. is just getting destroyed. I don't know what this lag is here. And here is our he just randomly gets up and goes and shakes hands with the president of China. President of China say, what the hell's going on here? So this guy's not pulling the strings. He's the puppet. He's the puppet. He's not pulling the strings. Every week, it's so easy. And then in the last 24 hours, these groups have stopped advertising on X, formerly known as Twitter. Apple, Disney, Paramount, Lionsgate, IBM, Comcast, NBC Universal. You go on any one of these companies' websites and see who their largest shareholder is: BlackRock, Vanguard, State Street. So I want to know who gave the order. Was there collusion between these big banks for them to stop advertising on this platform? Because that's a hell of a lawsuit that Twitter would have or X would have versus these companies. So you can just see they get the order from the powers that be because they don't want free speech. They hate it. There's a saying, sunlight is the best disinfectant. Well, free speech is the sunlight. And these demons here are the insects, and they need to be, I don't know, put in jail. No harm done, no physical harm. But these communists, these, for all intents and purposes, communists, they own 13 homes and are worth $61 million. Why is there not an audit of her and him? All they've done is be in public service all of their lives. How did you get all of that money? Biden, how are you living in mansions? You've been a public servant all of these years. Now, in terms of risk to the market coming out this week, and this is something I've been watching out for. Now, this is the Suez Canal. So important, but it's not the Straits of Hormuz. Because I can tell you right now, if you had this event, because remember, the Straits of Hormuz, which is basically controlled by the Iranians, and it's the entry point to the Persian Gulf. If you see one vessel get hijacked or get stalled out in that very narrow strait, you're going to see natural gas and oil prices just go skyrocketing up higher. Now, this is the Suez Canal. It's one ship, it's one event, but if the events continue to occur, you're going to see the Baltic Dry Sea Index rip up higher because that's the pricing power of dry bulk shippers. That means inflation due to shipping costs. You're going to see insurance rates skyrocket up higher, also driving up the Baltic Dry Sea Index. And this is going to be supply chain disruptions 2.0. So it has the potential for it. So keep an eye on, not this is one event, but multiple events. If this continues to happen, it's going to get priced into the market. This is one of those geopolitical risks that are out there, and it's a hot potato right now, and it's undeniable, and people need to talk about it. So just be aware. Israeli vessel hijacked by the Houthis or attacked by the Houthis. They're a rebel group out of Yemen, something like that. And that's in the Suez Canal. Now, in terms of gross domestic product in blue, relative to all sectors of debts, securities, loans, liability level, folks, this is a clear indication that for the most part, we're bankrupt. We're bankrupt on so many levels. In a lot of ways, morally bankrupt, but clearly on a financial view, we are bankrupt. This guy's got Weimar reference to pre-World War II Germany, post-World War I Germany, and their hyperinflation. And unfortunately, you know, the federal government has roughly three choices here to manage the debt. They could say, hey, we need to cut spending. B, we could default. C, we could print more money. What do you think they're going to do? And they're already getting the narrative ready for the starting up of the printing presses, which is what the Federal Reserve is meant for. We were taken off the gold standard in 1934. Nixon completely took us off the gold standard in 1971, and it has been Debtville ever since. And the purchasing power of the U.S. dollar has declined dramatically by like 90%. And you wonder why you need to have two parties of the household working. Now, this is, I found this interesting in that as a percentage of GDP in red, our interest expense was actually higher back in 1980 and 1990. And so Decades. For decades, we were higher than where we are right now because it really just goes to show you the markets can't take a five handle on the 10-year yield. Yet, for the vast amount of our past 60 years, we've had above a five handle on the 10-year yield. But we have so much debt that if we go through that five handle on a 10-year yield, you're going to see this red line go parabolic and just take out these highs like a hot knife through butter. Then you know things are getting real fast, and we are headed. You think we're going towards third worldville now? Oh no, we ain't seen nothing yet. Nothing yet. When we see a bursting of our interest expenses going through 1990 levels, that will be they'll be talking about default. You see the US dollar in free fall. Bonds will be going through the floor. The Federal Reserve will be tightening up or printing. It's going to unleash the dogs of war. It's really going to be very bad. I fear that happening to us right now. The fact that if for whatever reason yields spike up higher and we shoot through that five handle like a hot knife through butter, well, that means our interest expenses go up. That means they need to take money out of the private sector, which kills the private sector. It's taken out, put into the government, then so it's then taken and given to investors overseas who own our debt. And yes, at home here as well. But what you're seeing right now with all the wars, it's just the looting of America. It's in short, that's what it is. Now, over the weekend, Deutsche Bank reported that they're selling a building in New York City and they're going to take a $350 million loss. And we've been talking about this. We've been very consistent. This commercial real estate problem is a big problem. Oddly enough, the regional banks are breaking out. Go figure. But that just goes to show you that they're anticipating lower interest rates. So in 2014, Deutsche Bank bought a 780,000 square foot building for $500 million and is reportedly selling it for $150 to $200 million per the Real Deal. The office portion is just 31% occupied after Bank of America, their anchor tenant, vacated. WeWork also leased a significant amount of space, but this location is affected by their bankruptcy. Incredible. And this is not the only building. So for the bank, you know, they probably have the mortgage out themselves because they can't stick the keys to themselves. But you know, a lot of investors, a lot of other REITs out there, they're just going to be taking the keys. Here, bank, take the keys back. We're not going to make the payments on this property because we can't make any money on it. Just got to post some good stuff. All right, moving on. Temporary help requirement is contracting. So year over year, temporary help services declining. So usually what you'll see companies do before they hire full-time employees is they'll offer overtime for existing employees. Then they'll bring in temporary workers because they're not sure yet if the economy is going to hold up. It's looking better, but you know what? You hire an employee. That's like a marriage, and you don't want to bring that employee on unless you have to. So that's a sign of us potentially coming out of recession when you see temporary hiring services increase, as you did back here in 2009 and back in 2020. But we're going the opposite direction right now, which is implying that what we're seeing are no need for temporary workers because either they're paying employees overtime or they're just laying them off. So the weekly jobless claims came out hotter than expected last week. What did the markets do? They rallied on the news. Good news is bad news. Bad news is good news. all out of fear of interest rates, not about the common good whatsoever. You would think strong economic data, yay for the markets. No, they don't like it. But they will like it after we go through a downtrend in the economy and the stock market goes down. And all of a sudden, you start seeing durable goods orders come out positive, PMIs go to an expansion territory. Then you see equities respond wisely to, or what you would anecdotally expect, not anecdotally, intuitively expect them to do when there's good economic data. They rally. But that's only after the damage has been done to the economy and to the stock market. We're nowhere near that. Moving on. S&P seasonality. We spoke a lot about this back in October. I should be very, very careful going into November. While we look weak in October, and it looks like we could go weaker in November, we can't ignore seasonality. And sure enough, right on time, as like November 1st, money started rotating into the equity markets, and they just took off. And we'll go over to TrendSpider in a little while. We'll go over the historical averages for December in a moment. But clearly, November is going to finish off being a very strong month. And absent a geopolitical event, I don't see anything that's going to destroy that. So seasonality going into December and still a few days left in November, good. Favorable. Now, are we going to break out to new all-time highs? I think so. I think that it's a foregone conclusion that we are going to break out and at least retest prior highs. Maybe it'll fail on the first go around, second go around. They're going to blow through it, and we're going to go up higher. So the question that we want to talk about is the why. Why? Before we go to the whys, we want to take a look at the Dow Jones Manufacturing Index. Now, the Dow Jones Manufacturing Index is in a very, very tight triangle formation at the apex. This is either breaking out or breaking down very soon, next month, maybe even this month. But what you're seeing here at current, with several trading days left to go in the month, if I didn't say this is the monthly chart, you're seeing doji star formations. That's a sign of indecision. So what you read into that is that the probability, no guarantees here, but the probability of a breakout is very, very strong. So I would be looking at manufacturing names like maybe 3M. I haven't looked at this chart. Yeah, 3M, looking okay, beaten up. Those names are appearing to be more attractive. They're beaten up. They haven't really rallied yet. So those names are looking good. You could also look at the mining sector. The mining sector, this is a ratio chart relative to the S&P 500. It too, relative to the S&P 500, it's at the apex of a declining wedge formation. Usually this formation gets resolved to the upside. Every once in a while, you'll see a bear raid. They take it down below the lower band of support. Amateur bears try to short that, and they get their faces ripped off because after a couple of bars, all of a sudden it just goes ripping your face off and it breaks back out. So I think that this gets resolved to the upside, and you could see mining begin to outperform the S&P 500. Why? It's because if you're going to get a breakout back to the manufacturing chart, well, what are you going to need? You're going to need commodities. You're going to need raw materials, just like we talked about earlier with copper. Here's the continuous contract monthly view. This is a nice little tight consolidation here. This is how many months is this? This is 6 months of consolidation. So the tug of war between bulls and bears gets more and more aggressive each and every day. And right now, for the month of November, the bulls are clearly in charge. Now, if we get a breakout here on copper, you need to assume that you're getting a breakout on steel. Let's take a look at U.S. steel for a moment. Steel's already broken out. Not to new 52-week highs yet, but clearly the trend is up. Aluminum. Aluminum looking really, really good here. No new monthly lower low. That's the first step to end a bear market. And this has clearly been in the bear market. I think you need to start taking a look at Alcoa, U.S. Steel, Dr. Copper, mining, just mining in general. Now, what's the why? Why is this all happening? You know, in October, we were short the market. I was very bearish on the market. And to a certain extent, I still am. We're watching watching the yield curve, which I'm not going to talk about tonight. I spoke about it on Thursday night, so it's pretty recent, my comments. The reason why the markets are going to go up is because the Fed's done. There's no more rate hikes to be had. December, probability of a rate hike, 100%, nothing. They stay put. January, no rate hike. March, now they're pricing in nearly 1/3% probability. 1 day ago, it was only 28%. 1 week ago, only 12.4%. To be fair, a month ago, we were 11.2%. So the trend is clearly higher, right? We're rising. So expectations are that we are going to see a growing possibility, not a probability, but a possibility of a rate hike in March. But once you get into the May meeting, if we don't get a rate hike in March, a rate cut in March, come on, March. I think that then the probabilities of a rate cut in May are going to go through the roof. So right now, a probability of a rate, whoa, I'm sorry, they changed this. Wow. So I got to take a step back here. Right now, we are at 5.25% to 5.5% on the Fed funds rate. Going out to May, there's only a 14% probability that they won't cut rates. Easing is now at 85.9%. This is a moonshot. So now you know why the equity markets are about to take off, because the US dollar is tanking. The probability of rate cuts are soaring. What are the market participants going to do? The smart money going to do? They're going to get it. They're going to get ahead of the ball, and they're going to start buying right now in anticipation of those cuts. Because when the Fed starts cutting rates, we're probably going into recession, and you're going to want to be out of stocks. Because the Federal Reserve, to cut rates, they need to be responding to something that happened that's bad. And the equity markets will probably price that in before the Fed cuts. Now, you may assume, well, the Fed will cut, and then equities are going to go rallying right back up. No. That is not the historical trend. Usually, when the Fed begins cutting rates, the stock market goes down because it takes time for those rate cuts to filter through the system. And one rate cut is not going to do it. Remember back in 2020, the Federal Reserve would come out, they'd cut by a half basis point. Stock market would rally for a day. Next day, boom, down. That happened multiple times. The same thing is true moving forward, because I don't write the script. The script just keeps repeating itself over the course of past bubbles. So this is the why behind the rally. You could say, we can go through all these things I brought up, these charts, the news, the Deutsche Bank news. It doesn't matter. It's all BS. It doesn't matter until such time as it matters. What will that look like? Could be that a Deutsche Bank goes under, which it's not going to because it's a German bank and they'll just get nationalized. It could be a big bank that goes under. It could be a slew of regional banks that go under. Something that the Federal Reserve misses and allows for an institution to fail. It'll be one of those instances. But for right now, In the market's eyes, absent a geopolitical event or absent a fiscal nightmare, they're looking at the diamond jig. For you fishermen out there, you know what I mean. A diamond jig to a barracuda, and those are stock traders. And they are looking at that diamond jig of a rate cut in May and potentially in March, salivating. And they are going to go rushing towards that diamond jig, and they are going to bite or buy with reckless abandon. And if you take a look at a lot of the Magnificent Seven names out there, they're consolidating for the past several weeks, and they're getting ready to move up higher. Now, it's not just going to be this time around the Qs that are going to rally. I think that this time around, you're going to get gold, silver. We're going to go over those charts in a moment. We have a position in, I've had physical for a number of years now. We have an options trade, a long call options trade on GLD going out over a year. I plan on adding more to that this week. Members, I'll post in the Slack forum when we do that. So in 1928, on the $10 bill, in gold, payable to the bearer on demand. 1934, this is when Roosevelt took us off the gold standard. He banned gold from private ownership. Will pay to the bearer on demand. What does that mean? Give me $10. 1974, nada. They took us off the gold standard completely. So this is, I like the way he puts this, the fiat standard. This was real money. This is not real money. It's hope. And who we're hoping on is the competence of these villains. These villains in Washington, D.C., these demons. And I don't have a lot of hope in them. I really don't. I think that they're corrupt, very, very corrupt. And there is no America first in their minds. So you are on your own. If you wonder why Bitcoin at current is skyrocketing, now on the month, Bitcoin is up 8.20%, whereas the triple Qs are up 10%, respectable, and they are getting ready to, folks, they're breaking this out. They're breaking this out. As much as I think that they shouldn't because of the bad news that's out there, all the problems that we have, it doesn't matter. It's the market that makes the decisions. So what do we do here? Well, we know that the dollar is, in all probability, this is a weekly chart of the US dollar. We already went over this earlier, but you could see that while they may rally the dollar back to the 104 mark, it's probably only going to stay there briefly. It'll get rejected, and on that rejection, you're probably going to see gold take off once we break down below the lows of last week, or maybe we don't even get that retest. So ideally, we get that retest. We see the rejection. That'll kill the dollar traders. They'll become more bearish, and they'll put a lot of shorts behind the US dollar. So when we take a look at gold at current, I like the way they did this chart. 1981 to 2001, that was our base, a 10-year base, more than that. Huge rally. Gold was around, let's call it on average, $250 the ounce, rallied up to 1980.65. Maybe a little bit lower than that. I think that's the current price. Corrected, long-term base, rallied. Now we're beginning to break out yet again. Another way of looking at gold monthly chart. At current, we have already broken out. This is a line chart. I kept it as a line chart. It's a little bit easier to read the candlestick chart a little bit more noisy, and I wanted to drive home a point that the price of gold has broken out already. The only thing in our way is this resistance level here at $2,009.20. And I think we're going to blow through that like a hot knife through butter. Third time I've used that saying tonight. I haven't said that in a long time, and I don't know why I'm saying it tonight, but I think it's appropriate. Momentum picking up here. If I didn't say this is a monthly chart, volume to the downside, very, very light. I'm loving gold here. Silver doing great. Again, as I mentioned, we bought more silver last week. The AGQ. This is a leveraged ETF on the month up nearly 6.75%. Higher lows getting put in. Looking for a breakout here. Loving it. What about the mining stocks? They're struggling a little bit of backing and filling here. But remember what happened. You had the Israeli conflict occur. That put a bid under the gold mining stocks, but that geopolitical fear came off a bit. So what happened? You saw the fear come out of the gold mining stocks as well. Remember, the dollar was trading up. Gold mining stocks are strong, along with a strong U.S. dollar. I said it wasn't going to last. It was not going to last. Eventually, they would revert to the mean, and they did. Now, this is on Trader Isaac. Trader Isaac is on right now. I'm still watching DTL. You got to tell me how you did these different colors on this chart. I like that. Watching DTL on AGI with 21 EMA support for a gold trade. I like this chart quite a bit. So this is Alamos Gold looking really good here. Strong consolidation. Getting ready for a breakout. And while you have some volume bars above, meaning volume shelves, some resistance above, is not much. And again, you see a breakout on gold, the mining stocks you're going to see speculators pile into them. So good luck with that trade, Trader Isaac. Now, the only thing that's a fly in the ointment, it's going to be our last chart for the night, is the 10-year yield. Now, this is a monthly chart, 10-year yield. Now, we closed out the session on Friday right at this lower band of support. So the question is, do we break it? If the CME Fed Watch tool is to be believed, it breaks. If you see a reversal off of this lower band of support, that may mean that there's underlying strength in the economy, and that will not bode itself well for a rate cut in March or May. And what might that strength look like? Well, it could be strong CPI data, could be strong durable goods orders coming out next week. Consumer sentiment comes in gangbusters. That's inflationary. That would send the probability of a rate cut down. Because remember, what the Federal Reserve is trying to do right now, they're trying to create unemployment, and they're doing it. You saw it in temporary workers. There's not the demand there. They're unemployed. You're seeing it, or not working as much as they'd like to. You're seeing it in jobless claims. They came in higher than expected last week. So the Fed is getting what it wants, but if you get upside surprises to the economic outlook, well, then that could send this 10-year yield ripping up higher. So we're at a very, very critical juncture here on the 10-year yield. I want to take a quick look at the weekly view. A pretty bearish week last week. Close at the lows of the week, but the trend is still up. You can't ignore that. So to say, oh, it's guaranteed, yields are going to break, I think that's pretty arrogant. So I while I'm in that camp, because right now I'm seeing bad economic data, and that bad economic data is being priced into the Federal Reserve probabilities of a rate cut to address the bad stuff that's out there. You want to keep an open mind. Always keep an open mind, because in the end, we know nothing. All we're looking for are clues. We're Inspector Gadget with our magnifying glass out, looking at indicators, looking at charts, and going into each trading day with an open mind. That's the attitude. That's what we need to do. Now, we'll leave it off here with seasonality. I'll take some charts. We have 5 minutes to go. Seasonality for SPY first, and we'll do trip Qs. What did I do? Oh, by the way, since I'm on their website, they have a huge sale, 82% off, and they have free futures trading. Wow. Link below. Use that link. Don't use my discount code. Go over to their website, sign up. 82% off. I don't know how you're going to get this any lower. So I think that's lower than my discount rate. So I got to give them a call. Let's go to seasonality. That's what I wanted to go over. I pressed the wrong button. So going back 31 years, November up 77%, second best month out of the year versus April. Now, December is not the best month out of the year. A lot of people believe it to be. It's one of the best, but it's not the best. But the probabilities are very high, 67% going back 31 years, that we will close up on the S&P 500. Checking in with the trip Qs. Trip Qs going back 25 years, up 76% of the time in November. Oddly enough, up only 50% of the time in December. That's one of the worst months out of the year, if you could believe it. Now, I want to do something here. I want to check in with gold. Gold is up only 58% of the times in December, but the best month out of the year is January. So what we're doing is that we're heading right now into a seasonally favorable period of time for the GLD going back 19 years. So I think that with this data we have at our disposal, I think it's safe to say that it's wise that we add more to our GLD long trade using a call spread. And we've been just nibbling at it. One lot additions to that trade. Probably going to become a little bit more aggressive this week on GLD, especially if they give us a pullback early on in the week, which they're giving us right now. So that is that. Let's take a look at chart requests. And if you're still on and you posted your request earlier, if you could repost it for me so I don't have to go back through the comments, that'll kill your time. And I want to respect your time. I just got to go to the members area here. I should always have this ready. I don't. Okay. And we have nothing. No requests. Okay. Quiet night. Walmart for Jody. Go, no go. Oh, really? Go, no go. Go, no go. Trend indicator. You like it? Or are you just experimenting with it? Thanks, Trader Isaac. URA for Franklin. MSFT. Illumina. Okay. Indo. I think that's enough. Pete. Sorry for all caps. Don't worry about it. Not a big deal. SN. Yoga Mac. Tesla. I keep meaning to reach out to you on Twitter. I haven't forgotten. Is Yoga Mac your trader? Your Twitter handle? All right. I think I got everybody. All right, let's do it. I'll keep the seasonality open to the right. If you want me to get rid of it, I'll get rid of it. Walmart. Horrible earnings last week, and the shares were annihilated. So the good news is that they closed this right off of historical support. How do I know? I didn't draw these lines. This is the automated trend lines. Now, we have broken the lower band of the rising uptrend channel. That's no good. They'll probably get a rally this back up, say 3-4 points. I'd be a seller into that rally. I'd want to see a pullback and a higher low, a retest of recent lows. I'm worried about a break here on Walmart. Let me do a print screen of that. All right, I just did a print screen of that. There we go. Okay, so daily time frame on Walmart, big volume. So you're still seeing institutional selling here. You don't want to fight these guys. So what they're probably going to do here is if you see one or two more down days, they'll probably take it down to this volume shelf. At 157, 153.75. I'd be a buyer there. And then I think they trade it back up. And at some point in time, you're going to either hit resistance here at 157, or they're going to rally it. If the markets really begin to rally and you get some buyers of Walmart up to this prior lower band of support, but that's now going to act as resistance. So that's why I'm saying no rush to go buying here. Volume to the downside, still very high. Watch 153.75. I'd be a buyer there. I'd be selling into 157, then 158. I'd be out of it. And if they recapture support, then I'll revisit it. But the probability is improbable that we're going to immediately recapture prior support. Highly unlikely, but not impossible. We want to keep an open mind. URA. I love URA. This is uranium. Now, uranium, you could see to the right, both both November and December, up 62% of the time. So seasonality will continue to favor uranium. And last week, wow, what a beautiful move up higher. On volume, no less. Daily view. We're going up here. 28.99. If we break out above that, we can do a parabolic move up to this fractal trend line at around $31 a share. So uranium's in fuego. I would not short this name. It may look extended. It can still go a lot higher. I wouldn't even sell calls on this. Microsoft. Now, I have a strangle on Microsoft with a bias to the short side due to our unbalanced deltas. But I'm probably, so the question was, Microsoft is extended. Yeah, it's got to digest these gains. I have options expiring. We're options sellers, so I like when the options lose value. We have options expiring soon. The however is that Microsoft on a weekly time frame still looks Very, very good. And yes, it's very extended. So on any pullback, what I want to do this week is let's go back to the daily chart. On any pullback, I want to sell more puts. And that's a bullish bet because I think that Microsoft, yes, can pull back further, but I think that it will hold support levels and that it will join the rally when ultimately the triple Qs break out. Uh, Microsoft is the largest component of the triple Q basket. So, in all probability, Microsoft is going to be leading the charge on the triple Qs to that breakout. But is a consolidation warranted here? Yes. Illumina, ILMN. Now, Illumina is just being decimated. Wow. But we do have some support below. And we bounced off of it, not last week, but the week before. Let's go to a monthly view, get a better vibe here. We're very oversold. Monthly RSI is at 26. Weekly RSI is at 24. Daily RSI. Well, daily is looking interesting here. Daily, you're starting to see a bullish divergence on RSI. You've been putting in higher lows and not quite yet higher highs. Not yet. But I think that we are probably going to break out here on Illumina. Now, I've tried to trade the options on Illumina many times, and the options are very illiquid. So I'd have to do the common stock. I'll check in with the options and see if anything's changed first. In fact, let's take a look right now. The options may be expensive. Yeah, they are very expensive. So I would not be a buyer of the options here. I would be a seller of the options. I would not sell calls because this is a very volatile stock. And you could have a rip your face off short covering rally here. So I would look to sell puts, and that's the way I would trade this. I wouldn't buy the calls unless you're just going to buy the stock. But if you're going to buy the stock, why not sell the puts first, right, and possibly get a discount? I want to get a feel for the activity. And, usually the near-term options are the most active. And once you go past 1 week, there's not a lot of options activity out there. Look at the spread on these options. It's ridiculous. You can drive a truck through these spreads. So uh, I'll throw an offer out there. I'll keep it active for a day. If I get filled, I get filled. If I don't, I don't. You never know. But I would probably sell puts on Illumina or buy the stock outright. And you could try to sell covered calls. All right. And this coming month is the best month, I believe. No, second best month for Illumina. Illumina, seasonality-wise, from October through, actually, the trend begins in September, where you see the bottom of the seasonality low in August, and then you trend up higher through January. Then February, it falls apart. So I'd be a buyer here based upon technical analysis, based upon the seasonality. I believe they've already reported earnings. I would not hold this stock into earnings at all. So it's looking good. I like aluminum. Bob, Microsoft looks to be diverging on the monthly. Diverging from what though, M. McNeil? Diverging from the Qs? Oh, RSI. I see what you're saying. No, RSI is pretty much validating the move up higher. So if I saw RSI was flat or even worse down, I would say yeah, I agree that you're seeing some sort of a divergence there. But no, it looks okay. It looks all right. You look at the monthly RSI. There's a lot of room to go to the upside here. Weekly, the weekly closed flat last week due to the fact that we came off the highs of the week. So I think that we can get a further pullback here on Microsoft. I'd be eyeballing the 362 mark, 362.50. All right. INDO. I've owned this. ETF. I'm surprised this is not doing. Oh no, this is not the same thing. I thought this was the Indonesia ETF, which I did own. This is a different equity. Sorry. I need to go to a monthly view. I am not familiar with this whatsoever. Penny stock. I'm not loving it here. I wouldn't short it. I don't even know if you can get the share to short. Oil prices are, if we're going into recession, are probably going to come down. This stock wasn't able to rally on strong oil prices, and it's certainly not going to be able to rally on weak oil prices. Now, I don't know their business per se. I don't know what kind of energy they're in. Maybe they're a utility. I don't know. The only positive thing I could say here is that we are trading down at a historical support level. This fractal trend line on a weekly chart. So maybe we're bottoming out here. Maybe this is a W formation, double bottom setup. It's not a high risk trade. You can put the trade on Monday morning. Just use a stop below, $2.55. Keep your loss small. Daily chart. These bull flag setups or bear flag setups are pretty brutal. And you got to be careful that, Friday's price action began with the beginning of another bear flag setup. So the same thing happened back here. We had the big downdraft, boom. Then what happened? Pop up, failure, pop up, failure. And then all of a sudden, whoosh, you get the floor taken out from underneath you yet again. So beware of false bottoms. And this stock has been putting in false bottoms. I would buy immediately this week. Then I would take my trend line. I'd do this. And once it broke that trend line, if it breaks that trend line, maybe it won't. Then I'd just be out. Make my profits real. SN. Shark Ninja. Whoa. What does this company do? This is a beautiful chart. This is textbook. There's a lot of energy pent up in here. You've had several weeks of consolidation, and you don't have any overhead supply above. This is going up. It's going up. Lovely consolidation. It broke out here the week of October the 30th, did a retest, held, Another retest last week, reversal bar. I think this is going up next month. Sells coffee makers, cleaning products, and kitchen products. Watch durable goods next week for this stock. Thanks for that, Trader Isaac. Beautiful price action. There's nothing not to like about this chart. It's beautiful. Really, really nice. Bullish. The only, there's one thing. If this is only 3 or 4 or 5 years worth of data, I wouldn't even talk about it. This is 12 years worth of data. Seasonality, it's up only 50% of the times in November. December, worst month, third worst month out of the year. So be careful, but I think this is breaking out and going up higher. Tesla. Oh, Tesla. You can see all the work I do on Tesla. All my drawings here. Let's get rid of these. Okay, that's better. So we don't want to start with a daily view. We want to go to the macro view here because Tesla has not been a leader at all of late. There's a lot of reasons for that fundamentally. So from what I understand, the EV market, those EVs are not moving. And it's not just Tesla. It's all EVs are not moving off of dealer lots. Inventories are building. What does that mean? Price cuts. We are back above on a monthly time frame. Still several trading days left to go here. A couple of moving averages. Not a lot of resistance above until we get to 275. Weekly view. Now, on the week last week, this is what I don't like about Tesla, is that they broke it down on earnings the week of October the 16th. And consolidated, rallied back. Now we're back up and into this fractal trend line. And these can be a bear to get through. So it's a natural resistance level. You also have a couple of volume shelves immediately above. That's concerning. So one thing that went well for Tesla last week is that the up week was driven by very, very strong volume. You're going to need to get a lot more of that to get through all of this resistance above. Tesla, daily view. Again, a lot of resistance above. What's the number to watch here? 258.64 is the number to watch. If it breaks out above that mark, Tesla's going a lot higher. But right now we have a lot of overhead supply here. So you're going to get a lot of backing and filling, but one day you're just going to get that rip up higher, and you're going to get a multi-day short squeeze going on with Tesla. Shark Vac. I've seen them. Oh, Ninja Blenders. Oh, okay. I see. I think if Trump gets elected, we can short EV and clean energy with both hands. Yeah, I wouldn't argue with that. I wouldn't argue with that. All right, all. Guys, thanks for being here a little bit over. I want to say happy Thanksgiving to everyone. Please like, subscribe. Don't forget TrendSpider, 82% discount. Use the link below. We have, if you use that discount, you could sign up for our titanium level membership to the Contrarian Trader, because you'll get that discount on TrendSpider a lot cheaper than what I can provide it. So take advantage of a 14-day free trial we offer. Again, like, subscribe. Don't forget about our small account club. We posted the live stream yesterday. That's up. There's a link below if you want to get invited to those live streams beginning private in January. Link below. Don't forget about a 5-part video tutorial, top 5 favorite candlestick patterns, linked below, and that's free. TZ Burton, you are welcome. Happy Turkey Day to you, pal. Jody, same to you. Happy Thanksgiving. Happy Thanksgiving Day to you. Take care. Buy us some products. All right, all. You're welcome, Yoga Mac. Happy Thanksgiving to you too, pal. Don't be a turkey. Take profits. All right. Take care, all. Bye-bye.